I want you to imagine that you wake up tomorrow morning and someone has stolen your car. You call the police. They find it within an hour, parked 3 blocks away, completely undamaged. The thief did not take it for a joyride. He did not strip it for parts. He just moved it. And when you ask why, the police tell you something insane. The thief needed to prove to his business partners that he owned a car, so he borrowed yours for a few hours without asking. He planned to return it before you noticed. Would you press charges? Of course you would, because borrowing without permission is not borrowing. It is theft. The intent to return it later does not change the crime. Now replace your car with 100,000 ounces of silver sitting in a Comex vault. Replace the thief with J.P. Morgan. And replace the police with the financial media telling you that everything is fine because the inventory numbers look healthy. Ladies and gentlemen, and today, Monday, February 16th, 2026, we are going to walk through the greatest accounting fraud in the history of commodity markets. We are going to show you how the banks have convinced the world that they are solvent by counting assets they do not own and cannot legally access. And we are going to show you why the bill for this fraud comes due in exactly 11 days. The key to understanding the silver market right now is understanding one simple distinction. There are 2 types of silver in the Comex system, registered and eligible. The media lumps them together and reports a total inventory number, nearly 400 million ounces. And when you hear that number, you think, wow, there is plenty of metal. The shortage narrative must be exaggerated. But that 400 million number is a lie by omission. It is technically accurate, but functionally meaningless. Let me explain why. Registered silver is metal that the exchange can actually deliver to settle futures contracts. It has a warrant. It is available for sale. This is the inventory that matters. And right now, registered silver has collapsed to below 100 million ounces. Eligible silver is everything else. It is metal sitting in Comex-approved vaults that meets the purity standards but is not for sale. It is owned by private entities who are simply using the vault for storage. The Comex has no legal claim to this metal. The shorts cannot borrow it. The exchange cannot force the owners to sell it. Here's the scam. When the banks show you the total inventory chart, they are implying that all 400 million ounces are available to cover short positions. They are implying that the vault is full, but the reality is that 3/4 of that metal is off limits. It is not theirs to use. Imagine you own a commercial real estate building. You rent out office space to 50 different companies. Those companies store their furniture, their computers, their files in your building. One day, you need cash. So you take out a loan and you tell the bank, look, I have $10 million worth of assets in my building. The bank gives you the loan. But those assets are not yours. They belong to your tenants. You're just the landlord. You're providing storage space. If you tried to sell your tenant's property to pay back the loan, you would go to prison for fraud. The same principle applies to eligible silver. The Comex is the landlord. The eligible owners are the tenants. And the shorts are trying to convince the world that the landlord can sell the tenant's furniture if things get desperate. They cannot. Not without triggering the immediate collapse of the entire precious metals storage industry. Because the moment J.P. Morgan seizes privately owned eligible silver to settle a delivery demand, every family office, every sovereign wealth fund, every private investor in the world will immediately pull their metal out of New York and never come back. The trust would be destroyed. The business model would be finished. The Comex would become a ghost town. Let me give you the exact numbers so you understand the scale of this deception. As of February 12th, just 4 days ago, the total Comex silver inventory sits at approximately 381 million ounces. That is the number the media reports. That is the number that gets flashed on financial news channels when they want to calm investors. But when you break that number down by category, the picture changes completely. Registered inventory, the metal actually available for delivery, is at 98 million ounces. For the first time in years, it has dropped below the 100 million threshold. Eligible inventory, the private property being stored, is 283 million ounces. That means 74% of the headline inventory number is metal that the shorts cannot access. 3/4 of the so-called supply is functionally non-existent for the purpose of settling futures contracts. Think about what that means for the leverage in the system. Just looking at the March contract alone, the trajectory suggests that by February 27th, there will be approximately 120 to 130 million ounces of open interest held by longs who intend to take delivery. But the registered inventory available to fulfill those contracts is only 98 million ounces. That is a shortage of 20 to 30 million ounces on the March contract alone. And that is not counting the open interest in May, July, and future months. The total paper claims across all silver futures contracts dwarf the available registered supply. The banks are running a fractional reserve system. They have sold more delivery obligations than they can physically fulfill. And they are praying that most longs will close their positions for cash before delivery day arrives. So what do? They pray. They pray that the speculators keep rolling their contracts. They pray that nobody asks for physical metal. And they count the eligible silver in their inventory reports to make the vault look full. But here's what they are not telling you. The eligible category is not static. It is dynamic. And right now, it is moving in one direction, out. Over the past few months, we have seen a steady flow of metal draining from the system. In early January, registered inventory was at 110 million ounces. A few days before February 12th, it was at 101 million. As of February 12th, it dropped to 98 million. That is a drop of 12 million ounces in just over a month. But the drain is accelerating. On February 11th alone, 3 million ounces moved from registered to eligible, and another 4.7 million ounces withdrew from eligible entirely. That is nearly 8 million ounces of movement in a single day. Metal is flowing out of the vaults faster than it is coming in. This creates a death spiral for the shorts. As registered depletes, the gap between delivery obligations and available supply widens. As the gap widens, the risk of a delivery squeeze increases. And as the risk increases, more smart money withdraws, accelerating the cycle. If the current trajectory continues, registered inventory will be down to 70 or 80 million ounces by the time the March delivery window opens. But the March open interest suggests 120 to 130 million ounces will be demanded. That is a 40 to 60 million ounce shortfall. The banks cannot stop this. They cannot force the eligible owners to leave their metal in the vault. All they can do is watch the registered inventory drain and hope that they can keep the paper price suppressed long enough to convince the longs to sell before delivery day arrives. So when you hear that the vaults are full, remember what that actually means. It means the storage units are occupied. It does not mean the metal is for sale. Now, you might be thinking, okay, so the eligible silver is not available. But what about force majeure? What if the banks just declare a market emergency and settle in cash? This is the second part of the lie, and I need to kill it permanently because it spreads like a virus in every comment section. Force majeure is a legal escape clause that excuses contract performance when an extraordinary event makes performance impossible. And the key word there is impossible. Not difficult, not expensive, not inconvenient. Impossible. A hurricane destroys the vault. That is force majeure. A government bans silver exports. That is force majeure. A nuclear war vaporizes Manhattan. That is force majeure. But do you know what is not force majeure? Running out of inventory because you sold more paper contracts than you have physical metal. That is not an extraordinary unforeseeable event. That is a business decision that went wrong. That is leverage that backfired. That is a bet that lost. And contract law does not allow you to escape your obligations just because you made a bad bet. If a bank goes to court and says, Your Honor, we need to invoke force majeure because we sold 500 paper ounces for every physical ounce we own, and now the longs want delivery and we do not have the metal, the judge will say, then go buy the metal. Go into the open market and pay whatever price is necessary to fulfill your contractual obligations. That is not force majeure. That is called covering your position. And if the price is moved against you, if you have to pay $150 per ounce to buy metal that you sold at 76, that is your loss. That is the risk you took when you sold naked short. The banks cannot weasel out of this with a legal technicality. They have two options: deliver the metal or go bankrupt trying to source it. There's no third option. But here's where it gets interesting. Because while the banks are sitting in New York counting eligible silver they cannot touch and praying that nobody asks for delivery, the real price of silver is being set somewhere else. It is being set by the market that does not play accounting games. The market that only cares about physical reality. We need to talk about Shanghai. We need to talk about the number that the Chinese market locked in right before they went dark for the Lunar New Year. Because that number is not just a closing price. It is a ransom demand. Shanghai closed at $86.91. The COMEX spot price is $76.71. That is a $10.20 gap. And that gap is not noise. It is not a temporary dislocation. It is a structural break in the global pricing mechanism. Let me explain what this gap actually represents. It represents the premium that the Chinese market is willing to pay to secure physical delivery. It represents the difference between a paper promise and actual metal in your warehouse, and it represents the minimum replacement cost for any industrial buyer who needs silver to keep their factories running. Think about it from the perspective of a solar panel manufacturer in Shenzhen. You need 1 million ounces of silver this quarter to fulfill your production contracts. You can either buy COMEX futures at $76 and hope that you can take delivery in 3 months, or you can pay $86.91 in Shanghai and get the metal delivered this week. Which do you choose? You pay the premium every single time. Because the cost of a production shutdown, the cost of missing your delivery deadlines, the cost of losing your customers is far greater than a $10 premium on silver. So the Shanghai price is not speculative. It is functional. It is the price of certainty. And the COMEX price is the price of a gamble. Now here is why the 8691 number is so dangerous for the Western banks. Because Shanghai is closed for the next week. The market is dark. There is no trading. The price is frozen at 8691 until they reopen. This creates a floor, a hard, immovable floor. And the Western banks know this. They know that if they try to smash the COMEX price during the holiday, if they dump paper contracts and drive silver down to 65 or 60, they are just creating a massive arbitrage opportunity for the moment Shanghai reopens. Because the second the Chinese market comes back online, every trader in the world will see that gap. $60 in New York, $86.91 in Shanghai, a $26 spread. And they will buy everything in New York and sell it into Shanghai until the prices converge. Except they cannot, because the metal is not movable. The vaults are tapped, the export licenses are restricted, the arbitrage is structurally impossible. So what happens instead? The COMEX price has to rise to meet the Shanghai price. The paper market has to capitulate to the physical market. And when that happens, it will not be a gentle drift upward. It will be a gap. It will be a forced repricing that happens overnight. Let me walk you through the exact mechanism of how this floor operates. When Shanghai closed on Friday, they locked in 86.91 as the last traded price. This number now represents the settlement price for all contracts that were held through the close. It represents the reference price that industrial buyers in China will use when negotiating their procurement contracts over the holiday. Think about a solar panel factory in Guangdong province. They have a contract to deliver 100,000 panels by March 15th. Each panel requires 0.2 ounces of silver. That is 20,000 ounces they need to source. During the holiday, they are negotiating with suppliers, lining up orders, budgeting their costs. What price do they use in their models? 86.91, because that is the last known price in their local market. That is the benchmark. Now imagine the COMEX drops to 65 while Shanghai is closed. When the factory manager sees that, he does not think, great, silver got cheaper. He thinks, that is a mispricing. That is an arbitrage gap. When Shanghai reopens, my local price is going to be at least 86, and possibly higher, because of the volatility. So what does he do? He calls his broker and says, buy me 20,000 ounces in New York right now at 65, before the gap closes. Lock in the discount. Now multiply that behavior across every factory, every importer, every industrial buyer in China. They all see the same opportunity. They all rush to buy the cheap COMEX metal. And that buying pressure forces the price back up toward 86 before Shanghai even reopens. This is why the floor is unbreakable. Because the Chinese market, the largest industrial consumer of silver on the planet, will not accept a COMEX price below their last settlement. They will use any dip as a buying opportunity. They will arbitrage the gap using forward contracts, offshore swaps, whatever financial instruments are available. The Western banks can manipulate the paper price down temporarily. They can create a dramatic sell-off for a day or two, but they cannot sustain it. Because the moment the selling pressure eases, the Chinese buyers step in and the price snaps back. The 86.91 floor is not just a psychological level. It is an economic reality enforced by the procurement needs of the world's manufacturing base. And that reality is stronger than any amount of paper selling the banks can throw at it. The 86.91 floor is the bank's nightmare, because it sets a minimum threshold below which the market will simply refuse to believe the COMEX price is real. It acts like a magnetic pull, dragging the Western price upward whether the banks want it or not. But if you think the Shanghai floor is just a pricing anomaly, if you think this is just about China paying a premium, you are missing the bigger picture. Because what is happening in Shanghai is not unique. It is happening everywhere physical silver actually trades. And the proof is not in a price chart. It is in a police report. We need to talk about the crime scene. We need to talk about what happened in Shenzhen over the weekend. Because this is where the theory becomes evidence. This is where the supply shortage stops being an abstract concept and becomes handcuffs and arrest warrants. Shenzhen is the jewelry capital of the world. 70% of China's gold and silver trade flows through a district called Shuibei. This is where the refineries sell to the dealers. This is where the dealers sell to the factories. This is where physical metal changes hands in massive volumes every single day. And this weekend, Shuibei shut down. The police moved in. The government issued a red alert. Companies are being raided. Executives are being arrested. And the reason is simple. The system collapsed. A major trading platform called Jewel Rui was running a scheme that should sound very familiar to anyone who understands the COMEX. They were selling prefixed pricing contracts. Customers would put down a 10% deposit, lock in a price for gold or silver, and take delivery later. Sound familiar? It is a futures contract. It is a paper promise, backed by the assumption that metal will be available when the customer asks for it. But the metal was not available. When the volatility hit, when silver ripped from 76 to 120 and then crashed back down, the leverage blew up. The company could not source the metal to fulfill the contracts. And when the customers showed up asking for their bars, The vault was empty. This is not a Chinese problem. This is not a rogue company in a foreign market. This is the exact same structure that the COMEX uses. Paper contracts sold against assumed future supply. The only difference is that jewelry collapsed this weekend and the COMEX has not collapsed yet. But the timeline is converging because the Chinese government just banned prefixed pricing. They shut down the leverage, they forced the market to cash and carry only. If you want metal in Shenzhen today, you pay full price up front and you take immediate delivery. And what happened? Liquidity evaporated. Dealers stopped selling. The ones who still have inventory are hoarding it because they know they cannot restock. The flow has stopped. This is the canary in the coal mine. If the jewelry capital of the world, sitting right next to the refineries and the ports, cannot deliver metal, what do you think is happening in New York? What do you think is happening in London? The same thing, the same leverage, the same empty promises. The difference is that Shenzhen admitted failure and New York is still pretending everything is fine. But we know the truth. We know the failure is coming. And we know exactly when it is scheduled to arrive. I need you to open your calendar. I need you to look at Friday, February 27th, 2026, because that is the day the pre-fixed pricing of the COMEX gets tested. That is the day the paper promises have to convert into physical delivery. And if the system cannot deliver, the price does not drift higher. It detonates. Let me explain the mechanics. The COMEX trades silver futures in monthly contracts. March is a major delivery month. And the rule is that before March begins, you have a deadline called First Notice Day. In 2026, that deadline is February 27th. On that day, if you are holding a long futures position, you make a choice. You either sell the contract and take your profit in cash, or you hold through the deadline and demand physical delivery of the metal. Normally, 99% of traders sell. They are speculators. They do not want the heavy bars. They just want price exposure. The banks rely on this behavior. They rely on the fact that the paper contracts will be rolled over month after month without anyone ever asking for the underlying asset. But this time is different. The open interest for March is abnormally high, and the entities holding those contracts are not speculators. They are industrial users who need the metal for production. They are sovereign buyers who are accumulating strategic reserves. They are Chinese importers who are desperate for supply. These entities are not going to roll. They are going to stand. They are going to say, we do not want cash. We want the bars. We want delivery. Now let me show you the math that makes this a crisis. The registered inventory as of February 12th is 98 million ounces. And based on the current drain rate, by February 27th, it will be down to approximately 70 to 80 million ounces. But the March open interest, based on the trajectory of contract closures over the past week, is projected to be around 120 to 130 million ounces by First Notice Day. Do the math. 70 to 80 million ounces available. 120 to 130 million ounces demanded. That is a shortage of 40 to 60 million ounces. The COMEX will be mathematically insolvent on March delivery. They literally will not have enough metal in the registered category to fulfill the legal obligations of the contracts that are still open. So what happens? Panic. The shorts have to scramble. They have to go to the eligible owners and beg them to convert their metal from eligible to registered. They have to offer premium prices. They have to negotiate. But what if the eligible owners say no? What if the eligible owners are the same entities who are standing for delivery? What if China owns both sides of the trade? Long contracts demanding metal and eligible inventory refusing to sell. This is the checkmate. This is the squeeze. Because the banks cannot force the eligible owners to sell, they cannot seize the metal, they cannot declare force majeure, they have to go into the open market and buy at whatever price clears the demand. And when that happens, the price does not move from 76 to 86, it moves from 76 to 120. It gaps. Because the paper price was never real. It was always a fiction maintained by the assumption that nobody would ask for delivery. But the Shui collapse proves that assumption is breaking everywhere. The physical market is calling the bluff. And February 27th is the date when the COMEX has to show its cards. Now, there's one more variable in this equation that could render all of this analysis irrelevant. There's one event that could bypass the delivery squeeze entirely and send silver to $200 in a single afternoon. We need to talk about the Strait of Hormuz. While we are counting ounces in vaults and arguing about contract law, there is a narrow 21-mile wide channel in the Persian Gulf that controls 30% of the world's oil supply. And right now, that channel is on the verge of closing. The rhetoric between the United States and Iran has escalated to the point where military conflict is not a possibility. It is a probability. Carrier groups are in position. Drone harassment is increasing. And the threat that every energy market fears has been explicitly stated. We will close the strait if Iran fires missiles at a U.S. naval vessel, if they mine the shipping lanes, if they sink a tanker, the flow of oil stops. Not slows, stops. Insurance becomes unwritable. Shipping becomes impossible, and the global economy freezes. But the impact on silver goes deeper than energy prices, because what backs the US dollar is not gold. It is not the full faith and credit of the government. It is the US Navy. It is the implicit guarantee that American military power keeps the oceans open and trade flowing. If that guarantee breaks, if a carrier takes a hit and is shown to be vulnerable, the confidence in the dollar collapses instantly. Capital flees into hard assets. Gold and silver become the only stores of value with no counterparty risk. This is not speculation. This is the historical pattern. Every time a reserve currency loses military credibility, capital rotates into metals. And this time, with the COMEX vaults already empty and the Shanghai floor already set, the rotation will not be gradual. It will be violent. So as we head into this week, you have to watch two things. Watch the registered inventory, and watch the headlines from the Persian Gulf. One is the fuse, the other is the match. But watching is not enough. You need a plan for the next 11 days. First, this is wealth preservation, not trading. The risk is not buying too early. The risk is not having metal when the system breaks. Second, prioritize physical over paper. ETF clauses allow cash settlement when COMEX breaks. You get $76 while physical trades at $150. If you need liquidity, use PSLV over SLV. Sprott stores in Canada with better audits. Third, expect a price smash this week. Light volume during China's holiday is their last chance before February 27th. If silver drops, but registered inventory also drops, that is your buy signal. Fourth, do not wait. Every day, registered drops another 1,000,000 ounces. Every day closer to the deadline. The cost of waiting exceeds the cost of buying at elevated prices. Fifth, size based on conviction. If silver hits 150, buying at 76 is a huge discount. Position size must matter to your net worth. This is insurance against dollar collapse. Sixth, split your storage, some at home. Bulk in private vaults you control, segregated allocated storage only. Seventh, ignore noise. The real driver is structural shortage, inventory drain, and February 27th. Everything else is distraction. Eighth, prepare for volatility. Violent moves both ways signal the paper mechanism breaking. Do not set tight stops. Volatility is the price for being early. Here's the verdict. The eligible lie has been exposed. The banks cannot use metal they do not own. Force majeure will not save them. The Shanghai floor at 86.91 is unbreakable. The Shui collapse proves the shortage is real. And February 27th is the delivery deadline that ends the charade. The banks know this. They know they're trapped. And they know that this week, with China on holiday, is their last chance to shake you out. They will smash the price. They will spread fear. They will trigger your stop losses and try to paint the chart red. Do not fall for it. Every dollar they push the price below 86.91 just winds the spring tighter. Every ounce of registered inventory that drains just brings the default closer. You are standing in the eye of the storm. The winds are calm. The media is telling you everything is fine. But the barometer is dropping. The eligible owners are refusing to convert. The Shui dealers are in handcuffs. The strait is narrowing, and the COMEX has 11 days until the reckoning. Ignore the paper price. Watch the inventory. If it keeps dropping while the price goes down, buy with both hands. The floor is set. The squeeze is mathematical. The window is closing. This is Asian Guy.